morning, everyone. Welcome to our Wednesday morning trading session. My name is Eric Senft. I'm going to be your host here this morning. The markets just opened up, and they opened with a pretty substantial downside gap. Just some pretty wild overnight ranges of late. Not yesterday so much, but certainly the day before. All right, a really quick overview for those of you new to our trading room. What you're looking at here is the diversified trading system. And it's diversified because we've got three different points of view on the market. Across the top here, we have the Hawk Micro Scalper. Through the middle is the Falcon Swing Trader, and across the bottom is the Eagle Trend Trader. The charts I'm watching here are the NASDAQ. I've also got the E-mini S&P and crude oil on my other monitor, but please don't be shy. Ask for any market that's of interest to you. If it's available in my data feed, I'd be more than happy to pull it up for you. The way the DTF system works is we generate signals by these warning dots and triangle and hash marks, and we're actually just getting a signal here. So let me, you know what, I'm gonna take a moment here. This is a first micro-macro cross signal. We should get some follow through on that. Sure, here, what the heck. I was going to show you some of these things before I actually took a trade, but why don't we put that on? All right, the way the signals develop is first we get this warning dot along with an audio alert, and then when the signal parameters are met, we get a triangle and a hash mark. That tells us it's time to make a decision about this trade, about this particular signal. What we're normally looking for is we're looking for confluence. And what I mean by that is, in this case, it's a sell signal. We're looking for red bars, red trend lines, red filter, and a red signal. Now, not all signals are created equal. We do look for certain high probability setups, which I'll be getting into a little bit later. This happens to be one of them. This is called a first micro-macro cross signal. This is on the Hawk, our scalper. And it occurs when the micro line crosses over the macro line, and we produce a signal. So we got the warning dots, the triangle, hash mark. All right, what I'm going to do, because this is early, and I'd like to demonstrate the Trade Manager, this tool here on the right that I'm using, I've deleted my profit target and my break-even trigger. Hopefully we'll see the market run out a little bit here. Or not. This huge opening gap is going to be calling to the market. All right, why don't we put that on the shelf there for just a moment. They're struggling with the overnight lows, as you can see. I'll go here to the Falcon Swing Trader, where we're actually also producing a signal. This is our trend change signal. And you know what, I'm going to show you these blue dots that you see running through the chart here. These blue dots are part of the Trade Manager. The Trade Manager, we have 16 different stop strategies to choose from, and they're all customizable, so we can make them, you know, less aggressive or more aggressive, whatever you like. And what these blue dots do is they actually manage the trade for you. So now that the market is moving a little bit in our direction here on the Hawk, I'm going to implement, maybe let's go with a 3-period ATR. Yep, sure, that'll work. Okay, so watch what happens when I click Enable and Accept. The trade manager now has taken control of my stops, and I quite literally don't even need to monitor this trade anymore. I can go watch another market. I can other signals, say on the Eagle or the Falcon. And we're going to produce a little bit of a reaction here to the breakout below the low. Now I'm going to try to give this trade a little bit more room, so I'm going to hold my stop just for the moment. We've actually already hit our high probability profit target, but as I said, I'm going to try to show you how the trade manager could run this trade out some. And while I'm waiting for that, I'm going to make a couple notes in my trading journal about this trade. I took that trade fairly early. All right, so I'm going to enable the ATR again. And we'll see whether or not we can't run this down a bit. The first micro-macro cross signal that I'm trading here is an extremely high probability signal. It's a signal that you'll often hear me say in the trading room that I take almost without exception. Now, while we're letting this trade percolate, let's go take a look here at the Falcon Swing Trader, where out of the open we also had this signal here. This is our trend change signal. With the Falcon Swing Trader, we pay a lot of attention to this line that's running through here, our trend line. When it's green, we're looking to buy. When it's red, we're looking to sell. And just like the hawk, we're looking for confluence in our signals. So we're looking for everything to be in sync. And you can see, well, the warning dot that produced here actually got absorbed by the triangle and hash mark. But there was a warning dot, an audio alert, and you can see we've got a red trend line, red bars, red signal, red filter. That's a sell signal for us, a high probability sell signal. And you can see we're currently at our high probability swing target. And we could have banked a little profit there if we chose. These horizontal lines that you see running through here, this is the ultimate support and resistance suite. These are what are known as a system add-on. And what that means, it's a standalone indicator. Excuse me here for just a second. I'm going to force my trade to break even. Oh, we are at break even. Okay. The support and resistance suite, this is a standalone indicator. It will work on any chart, not just a DTS chart. And these are 21 support and resistance lines that are forecast for today's trading. They are not floor pivots, and they are not Fibonacci retracements or anything of that nature. All modesty aside, I think they're actually much better. With the lines here, we've got the gold line in the middle. That's the median line. That one kind of sets the tone for the day. Above, we have the primary resistance. Below, we have the primary support. These three lines tend to be strongest. Once the market is below the primary support, we have secondary support. The market will have bearish tendencies, and above the primary resistance, the market will tend to be a little bit more bullish. So something for you to keep a lookout for. Okay, looks like we did get tagged here at break even when the market made that little bit of a reversal. Okay, now we're going to produce a green bar sell. Looks as though they're going to try to get into that opening range gap this morning. That's very ambitious. Alright, so what we're looking at now is a green bar sell signal. I know I mentioned that we normally look for signals where everything is in sync. Well, the green bar sell is the exception to that. This signal tends to develop near the end of a trend. And you can take the signal with the trend. In other words, we've got a sell signal. We've got a red warning dot, a red sell signal on a green bar. We normally expect to see the market retest the lows before it fails. You could also look to reverse on the trade and buy the green bar sell. In other words, if this signal unravels, if it doesn't move lower and trades higher, you could also buy that signal. Or you could just use it as a warning dot or a warning formation that the market might be reversing. If you're not into counter trend signals, if this market is unraveling and heading the other way, we're going to get a first micro-macro cross signal higher. So you don't need to rush into anything. All right, while we're letting that mature, let's take a look here at the Eagle Trend Trader. The Eagle Trend Trader, as the name suggests, is a trending tool. And we pay particular attention to this band that runs through here. This band gives us our directional bias. When the soft edge is below the hard edge, we look to sell. And when the soft edge is above the hard edge, we look to buy. The Eagle, like the other tools, we tend to focus on signals that have confluence. So once again, we're looking for everything to be in sync, green bars, green signal, green filter. There are a couple exceptions, but primarily that's what we're looking for. Now we got a signal here just about a half an hour prior to the open. I wonder if that one hit its high probability target. Let's take a look. Oh yes. So hit the high probability target. Now we're getting a little bit of a reaction. That's not unusual, by the way. When the market hits the high probability target, it's not unusual to see some sort of reaction. All right, Craig. Craig asks, please explain the micro-macro cross again. Absolutely, Craig. So that's a signal that's unique to the Hawk scalper. It's called the micro-macro cross because the thin line we call the micro line, the thick line we call the macro line. When the thin line crosses the thick line, the first micro-macro cross signal is the first signal where everything is in sync. So we had one here. Well, no, see, our macro line was not in sync yet, so this would be it here. This is one here. This is one here. So you can see what I mean about it being a very high probability signal. Here's one. And it's very easy to identify. Once again, here, let me clear this. Once again, it's when the thin line crosses the thick line, and it's the first signal where everything comes into sync. Now, don't let the simplicity of this fool you. This is not just a moving average crossover signal. There's actually about a half a dozen parameters working in the background here that have to be met before the system even produces a warning dot. So there's a lot of algorithms working behind the scenes here. It's not just, one moving average crosses another moving average. That's not it. Otherwise, you'd get a signal right over here somewhere, right? When the moving average lines cross. Here's another first micro-macro cross. Here's another. I don't know if this one actually hit its profit objective. Oh, came up. May have hit your break-even trigger. If you're using a break-even, an auto break-even trigger, it may have engaged that. Otherwise, nope. Did a little bit of a reversal on you. So here's something you'll never see in another trading room. A trading room moderator actually pointing out a false signal to you, a losing trade. You know how everybody likes to cherry pick trades. The signal is very high probability, like in the, I don't like to say it because it sounds so false, but really it's like 80% or better accurate. However, it's not 100%. That's why we use the trade manager here. And the trade manager, well, I guess a good time as any to explain the trade manager. The trade manager is a tool that not only has all these different stop strategies with it to help you manage your open positions, but perhaps even more important, it helps you control your risk. There's two modes for trade manager. There's the risk mode and the manual mode. The manual mode will default to whatever quantity is up here. So let's say you just want to trade single contracts. Okay, just go to manual mode. In manual mode, you will always just get one contract. If you always want to trade 10 contracts, in manual mode, you will always get 10 contracts. The risk percent mode caps your risk at whatever this value is. Currently, I've capped my risk at 2% of my capital. So what that means is no matter where I place my stop, my risk amount will not change. It's kept at a constant 2%. But what will change is the quantity. So you see here, I'm risking $420. If I set up the trade like this, oh look, I'm still risking about $420. That's 2% of my capital. But what has changed is the quantity. So at one time I was trading 7 contracts. This way I'm trading 2. But obviously by keeping my stop a little bit further away, I'm increasing the probability of a successful trade. In other words, having my stop back here, it's more likely that the market will hit my profit target before my stop loss than if I place my stop really, really tight. Right? That should make sense. I've got a lot more room here than if I place my stop right here. But sometimes the market comes up short. Like I said, if we had our auto break-even working, okay, great, we're out at break-even, but let's say we didn't. So we're short on our profit target, and the market gives us very little chance to react, and boom, we get stopped out. Okay, that's very unpleasant, to be sure. But the good news is I have not lost more than I can afford. Right? I've lost 2% of my capital. So if you're trading a $10,000 account, that's $200. That's not going to wipe you out. A $200 loss. Yeah, it's no fun, but it's not going to cripple your account. You're going to run into problems when you start losing $1,000 on a $10,000 account, or $1,500 on a $10,000 account. That's what's going to hurt you. All right, so it's a very high probability signal, but it's not 100%. There's another one. There's another one. So you can see great follow through on the signal. And again, the signal that you can almost take without exception. This one, it actually printed right here. It didn't engage until the market went up here a little ways. This is actually another signal. We took this one the other day, or sorry, this is in the wee hours. We took one similar to this. This is called a 4-arrow consolidation, another one of our high probability signals. So you're probably wondering, okay, Eric, what do those high probability signals look like? Sorry, I can't multitask. There we go. What do all those, oh, see, we had another one right here. So we had the one out of the open right here. And now we just had another first micro-macro cross signal right here. So what do those high probability signals look like? Let me show you very quickly. All right, so here we go. So we've got the first micro-macro cross, the macro line pullback, which I'll show you this morning as well. It occurs when the macro line changes, the micro line changes color. That's the thin one, but everything else stays in sync. The 4-arrow consolidation, the post-consolidation pattern, which coincidentally in this scenario was also a macro pullback, and then the red bar buy or green bar sell that you heard me mention. Yeah, Mark says you just missed a good one. I know. It's terrible. Right there, that's a beauty. All right. Okay, a couple great questions here from Tom and Bo. You're both hitting on the same thing. Tom mentions the hardest part seems to me to make up the $400 loss on a $100 profit target. And Bo says, do you mean that you're comfortable risking more than your potential reward per trade? Okay, now I'm going to go on a little bit of a rant here, because for those of you who have been in the trading room before, you know I'm not a big proponent of risk-reward ratios. And I'm not picking on anybody, so please don't take offense at what I'm about to say. But why would you base a trade on the reward side of the equation? The reward side of the equation is the one thing that you don't know. Right? You don't know where the market's going to go. Nobody knows where the market is going to go. If anybody tells you they know where the market is going to go, they are lying. We all have our best guesses, but nobody knows where the market is going to go. Case in point, we're producing a first micro-macro cross signal. Now, the way everybody's been taught is, oh, I need to have at least 3-to-1 risk reward to make my trade work, right? So you look at this trade, and what do? You don't look at the risk side. You're looking at the reward side, and you're looking and you say, oh gosh, you know, there's stops, there's support right down here. I can only afford to risk that much to get my reward, right? I can only afford to risk $20 and hopefully make 50. Sounds good on the surface, doesn't it? What's the problem with that? Well, the problem is the market brings you in, stops you out, and then goes on to your profit target without you. You're basing a go, no-go decision on the reward, and you have no idea where the market's going to go. And what ends up happening is you pass on this trade because you can't formulate a decent risk-reward ratio, and then all of a sudden the bottom falls out of the market. And you're left saying, why did I not take that trade? Counterpoint. Here is a buy signal, right? It's a buy signal. So you look at this and you say, ho, 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 look at all that reward up here. Oh, I can easily take that. So I'm going to, let me change this. I'm going to click my targets. So I'm going to go in here. I'm going to cover the trade down to that little swing. Let's see, there's one, there's two. That's great. I can get twice my profit or twice my risk in profit. Great looking trade, right? What happens? Market brings you in and then tanks. It stops you out. So, by trading risk-reward ratios, not only do you miss good trades, come on, mouse, not only do you miss good trades, but you end up taking stinkers. Risk-reward ratios do not work. So what does work? What does work are probabilities, if you focus on high probability signals. So, here's the first micro-macro cross signal. I know from experience that this is a high probability signal. As I said, to the tune that it's correct 80% of the time, or better. So I take my high probability signal. My risk, remember, I'm in percent mode. My risk does not change. It doesn't matter whether I place my stop right here or whether I place my stop up here. My risk does not change. What has changed? The probability of a successful trade has changed. If I keep my stop really, really tight, I'm not giving this trade much room to move against me, right? I'm not giving this trade a whole lot of opportunity to get to its profit objective. I'm essentially strangling the trade. If my risk amount is going to be the same, regardless of whether I have a loose stop or a tight stop, why would I not place a reasonable stop? So, actually, fundamentally, the best stop would be above that swing high. Okay, so let me adjust this a little bit just so I can get an extra contract in there. So we'll go above that swing high. Nope, still not there. All right. So my risk amount does not change. I'm risking 2% of my capital, which is essentially $400, and I'm going to make about 100. Now, I know on the surface it seems very lopsided. The market brings me in. Is there a better example? No, okay, it goes right against me. And I hit my profit target. But at no time was my stop in danger, right? It's only a loss if you actually get hit. All right, let's go here to let's say we take this signal. This is not one of our high probability signals, but let's say we take it. So once again, where's the best place to cover this trade? Well, the best place to cover the trade is up here. Why? Because this gives me the greatest staying power. If I place my stop tighter, I risk getting stopped out prematurely. Okay, pretend for a moment we didn't hit our profit target. And you see I end up getting stopped out. Whereas had I run a more reasonable stop, say up here, I would not be stopped out. Now watch what happens. Okay, so the market peels against me a little bit. It happens, right? The market rarely makes a straight line to where it's going. So it bounces around a little bit, it comes against me. Now it's starting to go in my favor again. Well, now that I'm a seller, right? Now that I know the sellers have recommitted to the market, I don't need to leave my stop up here. I can bring my stop down here. And now I can start to adjust my stop as the market heads lower. And I can continue to adjust my stop and so on and so forth. Let's say I hold my stop right here. And let's say the market makes a quick reversal and stops me out. So my initial risk was 340. Now I'm looking, say, I don't know, that's about 120, maybe 150. We'll say 150 for easy math. So whereas this was 2% of my capital, now I'm down to only 1% of my capital that I have lost. I've incurred a 1% loss, which is essentially nothing. Yes, it's still a loss, but I gave this trade every opportunity to get to its profit objective. Well, and it so happens that it did reverse and stop me out there. So even though I got stopped out, I never lost an amount more or greater than I could afford to lose. You're going to run into problems when you start losing more than you can afford. This is why the trade manager is so important. The other thing the trade manager does for you is it always keeps you correctly capitalized so that when you hit those winning trades, you maximize your earnings. So you've capped your risk at an amount you can afford, and you've also maximized your earnings because we're taking more contracts, right? In this instance, I can afford 2 contracts if I set up the trade this way, and I've earned money on 2 contracts. What do most traders do? Most traders say, oh, I'm just a little trader. I'm going to be careful. I'm just going to take single contracts on everything. Okay, that's great. So you set up your trade like this, and you say, oh, look, I'm only risking $200, and I made $65. Great, you made 65, I made 130. So what you're doing wrong is you're losing more than you can afford, and you're winning less than you should. You're doing the exact opposite of what you should be doing, and then people wonder why they can't make any money trading. So I know I went on a little bit of a rant there, but I just see people doing it wrong all the time. You know how professional traders do risk reward, and you will hear professional traders refer to risk reward ratios. You know how you can tell the professional traders? They talk about risk reward in hindsight, after the trade is done. After the trade is done, let's say we took this first micro macro cross and we set up the trade like so. We went 2 swings back, and let's see, we went with parabolics just for kicks, and we got stopped out down here. Professional traders will say, oh, well, we had almost a 1-to-1 risk reward on that trade. Or I guess 1/2 to 1. Or let's say they set up the trade this way. We'll make it a little bit more extreme for demonstration purposes. They'll say, oh, well, we had like a 1.5, 1.25 to 1. That's how professional traders do it. They analyze their risk reward after the trade, not before, because they know that the market will go where the market will go. And after they're done, they can say, oh, this is how we did our risk reward. Or, to be fair, sometimes what they'll do is they'll start off like this. So here's your first micro-macro cross signal, just as an example. And the signal engages, and what they'll do is they'll say something like, oh, all right, there's kind of the last swing. Let's see if we can't get a one-to-one out of that. So they'll set up the trade like that, and like this, and that will be their trade. Or if they choose to split up their position, maybe they're going to take half at target 1 and half at target 2. And so here they go target 1, and then they move there's target 1 there, and then they move their little block, and I'm not going to be able to do it, so I'm going to eyeball it, and that will be target 2. Right? So they take this range, there's target 1, there's target 2 approximately. Traders will do that, and they'll say, oh, well, okay, we got 2-to-1 on our second target, 2-to-1, right? They'll do it like that. And so then they come down, hooray, hit our first target, and now we're sweating the trade a little bit, trying to get down to target 2. Traders will do that. So you can see you can also set multiple targets here. You can preset targets, but it's so important to focus on your probabilities and not strangle your trades. And this is something that most traders never get a handle on. All right, got a little sidetrack there. Chris is asking, are there certain times to trade or 24 hours trading? Do the high probability trades occur 24 hours? They occur 24 hours, Chris. And of course, you can trade markets that are native to their time zone. So for instance, I live on the West Coast in the Pacific Northwest. So the North American markets are native to my time zone. If I was trading at 5 o'clock in the evening, that's when the Asian session opened. So I would focus on the Japanese yen, I would focus on gold, I would focus on markets that are native to that time zone. If I was up at midnight or 1 a.m., that's when the London markets open. So I would focus on the euro, the British pound, Brent crude, the stocks 50, the CAC 40, stuff like that. Right? So you'll always find a market that you can trade that it's daytime somewhere, right? But yes, the signals develop 24 hours. So just as for instance, we've been looking here at the hawk on the NASDAQ. Let's go into the wee hours. So here's the London open. Well, we had a first micro-macro cross right here. About 40 minutes into the London session, we got a first micro-macro cross and a nice little decline. That could have been your day right there, or your night, depending where you are. The Europeans tend to be a little bit more civilized. You tend to get some very good follow-through sometimes, but I do believe that yesterday it was very quiet in the overnight. Hold on, I'm going to make everybody dizzy here. All right, so here was the overnight yesterday, and you can see it was a lot more subdued. The North American Open down here. It did produce a 4-arrow consolidation, which is one of our high probability signals. Got a macro pullback, probably enough for a scalp, another macro pullback here. And this is just the one tool, right? We have 3 different tools to take advantage of whatever the market happens to be showing us. Bo brings up a good point. Bo asked, does a higher win ratio matter in this regard? Yes, absolutely. The higher win ratio, we've all gotten these spam emails in our inbox. It's funny, when they first started coming out, they started saying, new trading system produces 76% win ratio. And it crept up from there. I got one the other day, no word of a lie. It said new trading system produces 100% win ratio. Really, 100%. That's pretty good. You never have a losing trade. Yeah, let me buy that. What do they say? Shut up and take my money. Yeah. You know how you get a high win ratio is you have a tight profit target and a looser stop. That makes it easy for your market to find your profit objective before it hits your stop loss. The E-mini S&P, for instance, and I quote the E-mini because I have the stats for it, but if you want to know how to be correct 98.5% of the time in the E-mini S&P, and I'm not joking, this is an actual fact, 98.5% win ratio in the E-mini S&P. Trade for one tick. That's right, folks. Nearly 99% of the time, the E-mini S&P will move one tick in your favor. I don't care what you use for an entry system or a signal. Here's the hawk now on the E-mini S&P. Look at all these signals. The E-mini will move one tick in your favor. There you go. You got your one tick. Big deal, right? You can't make a living on one tick. Your broker will love you. You'll get a really nice Christmas card from the broker. Maybe even a fruit basket. All right, so Tom has a good question here. Okay, you guys got all good questions. Hold on, I'm going to get to everybody's here. Tom asks, so how do we determine a high probability trade without revealing? Excuse me a second here, folks. The alarm company is phoning me. 1 second. Sorry about that. Okay, so back to Tom's question. Tom's asked, so how do we determine a high probability trade without revealing? I don't have a clue how to figure it. I mean, to determine it by previous high or low or by support and resistance. I see we're keeping a runner having multiple targets, so how do we determine a high probability target? All right, there's lots in Tom's question. I think Tom is getting at, how do we set up a high probability trade? Well, okay, as far as the DTF system goes, we have our high probability signals. We have our first micro-macro cross signal. We have our macro pullback signal. These signals were all developed over an extensive period of testing. 9 months, in fact, and I remember because that's how long it takes for a baby to be born. Well, this was the indicator warehouse baby. Over the 9 months, we developed things like the trend change signal here in the Falcon, which is also a late filter entry signal. We have actually a trend change and a late filter entry signal going the other way as well. These are both very high probability signals. You can increase the probability of your trade, however, by keeping a reasonable stop. And by reasonable, I mean go with a fundamental point, a swing point ideally. So here's our trend change signal on the Falcon. This is the one we got right out of the open this morning. And even though the DTF system is very good at picking up momentum, in other words, the signal will usually only print when there's high enough momentum behind the market. Very often you could get by putting your stops right there, but that's not a very reasonable stop. That's not going to give you a whole lot of staying power. If the market looks back even a couple of ticks, boom, you're out. You have a loss. So where's a more reasonable stop? Probably right above there. If the market engages me here and then reverses and takes out that swing high, then I can say, yeah, I'm probably on the wrong side of this trade. And as it happens, the market comes down, hits our high probability target, and then reverses and comes back with another sell signal, right? Another trend change signal right through here. So you can do it all over again. Now, normally I suggest you go 2 swings back. Or if you have the ultimate support and resistance suite, you can always hide your stop above the next resistance line. That's usually pretty safe. And then the market goes down and hits the next support zone. As far as choosing high probability targets, a lot of times I will rely on the support and resistance suite lines for potential targets. Omar El-Tuki, who trades the DTS system on the Forex markets, is always using the support and resistance lines as potential targets. So on this trend change signal right here, I can guarantee you that, that Omar would be looking for a trade that looks something like this. He'd cover below there and he'd probably take profit before the primary support line. So that's what I imagine Omar's trade would be looking like. Now remember, just because you start with the full risk amount doesn't mean you have to stay there. Every time the market, takes out a swing high, you can roll your stop. So it breaches here, you can take your stop, you can roll it here. It breaches here, you can take your stop, you can roll it here. Or, we're close enough that you can go to break even. So even though you may have started with $400 at risk, doesn't mean you have to stay there. This is your safety net. This is, the market comes unglued, makes a beeline to your stop. This is your safety net. It's an amount that you won't blow yourself up on. That's why it's so important. But it's there for your protection. It's not there for you to manufacture some sort of fictitious risk-reward type trade. Rich asked, with 2% risk, is it reasonable to expect a month-to-month average a 20% return on a $20,000 account? Yes. I know. If you're looking for something a little bit more elaborate. Yeah, I don't think making $1,000 a week is unreasonable. $4,000 for the month. We do it in the trading room. There's days, yesterday I had a bit of a stinker and I ended up in the red, $300 on the day, but normally we're posting $200 or $300 gains per contract. So if you're trading, 2 contracts, that could be $600. 3 contracts, that could be almost $1,000 just on the day. So yeah, I think it's pretty reasonable. One thing I will tell you though is if you risk more than 2%, you risk damaging your trading capital. And then I know for sure you're not going to be able to make your returns. Okay, I'm glad you guys are asking questions because the market's kind of gone a little bit flat after that initial rally to the downside that we saw. They did make a little bit of a recovery here. We got a couple signals on the Falcon and the Hawk. The Eagle still kind of lagging a little bit after that initial run down out of the open. So here was that open signal. Move down. We are producing a green bar sell. And we're getting close to the crude inventory report. So I'm sure somebody's going to mention that to me. Okay, I see there's a lot of questions here. Please be patient with me. I will get to everybody's. And while we do that, let's take a look here at crude oil. This is crude oil now on the Falcon. We could do it on the other tools, but we'll choose the Falcon here for this morning. Now you can see crude has made a very tight little trading range. What I'm going to do is I'm going to use the OCO function on the trade manager, and we're going to bracket this range for the pending crude report. So I'm going to sell, and let's say here we're just talking about using profit targets. Let's see if crude can move 3 zones. So here's zone 1, zone 2, zone 3. I'm going to take profit right down here. All right, so there's my sell order, and then my buy order I'll place above the top end. 1, 2, 3, and let's see if it will move 3 zones to the top side. So I've got 2 different OCO orders here. I've got OCO 2 and OCO 1. And what will happen is if I cancel the one order, the other order that's linked with it will also cancel. So this is a different way that I'm doing it today, so hopefully everything will work out. Normally what I do is I bracket like this and then place my profit targets. We'll go with maybe a parabolic stop. Sure, let's keep it nice and cozy. Put a parabolic stop in play. And in a few minutes we'll have the crude inventory report. Now these orders are live the moment you put them on your chart. In fact, what you could do, seeing how the primary support line is pretty much skewering the market, why don't I enter above the median line and we'll sell below the support. We'll sell below the support line. 1, 2, 3. Yeah, we'll take profit 3 zones away. All right, there we go. There's our trade. Yeah, Mark says jokingly regarding those spam emails, he says, I'm holding out for that trading system that produces 150%. Then I'll be right. Then I'll bite. Bo's asking, what is your ideal target for crude oil and the NASDAQ intraday trading respectively? Well, are you asking a daily target? Daily target, I like if I can make 5% on my capital. That's a great target for me. If you're talking ranges, well, crude oil typically will make 100-point range in a day, anywhere from 80 to 100 points. So that's anywhere from $800 to $1,000 in a day. We also have this nifty little tool up here. I happen to have it here on the Hawk. This is called the Day Ranger. This is, again, one of those system add-ons. And the Day Ranger, well, tells you the daily range. So you got your 30-day average, 10-day, and 5-day averages. And you can see that 5-day average 162, 10-day average 150, 30-day average just shy of 170. So the market's all over the map. Sometimes it's obviously expanding, other times it's contracting. Right now it's all over the place. But let's say we take the 10-day average of 150 ticks. All right. So now you say, well, I'd like to take 20% of that as my profit target. So you would look at 30 ticks as your profit objective on the day. Or you may say, oh, I'm going to run 10% of that as a stop loss, in which case you could go to the fixed tick strategy and you could run a 15 tick stop, say off of the low. And that would look like that. Oops. Let's get it on the right side. And that would look like that. That would be 10% of the daily range that you would use as a stop loss. So the Day Ranger, a great tool for helping you take advantage of what the potential optimal range for the market is. Because, of course, it does change, right? See, like here on crude oil today, we're only up to 58 ticks. Yesterday was 172, which is well above average. It looks like the average range going from around 100 to 120 ticks. So crude oil probably owes us another 70 ticks on the day. So knowing that, if I'm trading at 49, well, maybe I should bring my profit target in a little bit. Stop that. Okay, when your chart does that, you need to freeze it. And then I can adjust it. There we go. This will be a little bit easier now for the market to reach. Okay, a couple minutes still till crude inventory. I might be able to sneak in another question. Yeah, Ranjit asks, if one was to build up one's account, then one could trade for one tick using the E-mini S&P using multiple contracts and possibly make a living this way. Yes or no? Only if you cut an extremely, extremely sharp deal with your broker. Because the commissions and the fees will pretty much eat up that one tick. Like right now, a lot of brokerages you can get by trading less than $5, but then you have the exchange fees, which will likely match that. So you're looking at around, anywhere from $7 to $10 per trade. Well, $250 per trade. That's not going to make you a whole lot of money. You got to trade 10 contracts just to get $25. Yeah, Moses is asking about these add-ons. Yes, Moses, these add-ons are not part of the DTS system. You can add them to the DTS system, or you can add them to whatever chart you happen to be trading. If you're trading a 5-minute chart or a tick chart or a point and figure chart, you can put these support and resistance lines on. Or the Day Ranger, that's also an add-on. If you're interested in the DTS system, however, talk to Adam, because very often he can bundle these tools for you so that there's a little bit of savings. And before I forget, there's a promotion on this week for Halloween. Indicator Warehouse has got a Halloween promotion. I believe it's 15% off. So if you're interested in some of these indicators, there's an opportunity to save 15%. And I would advise you to email Adam at indicatorwarehouse.com. All right, so there we go. We've got filled huge. Oh no, not a bad slip. I was going to say we got a huge slip on the upside. And we got tagged there on the little bit of a hiccup on the parabolic. Now there's our trend change signal. I'm going to show you another way to trade the crude oil inventory report. That's to allow the inventory report to actually release. And a few seconds after the inventory report releases, we're going to get a little bit of a range here. We're going to see what the high is. We currently see what the low is. So we could throw a sell order in below there. Let's see where the high starts. Is that going to be it? There we go. Come on. There we go. So there's the high. There's the high. There's the low. Actually, you know what? We're in the demo room. I'm going to make this a little bit more interesting. We're going to short below this little low here. This was at the beginning of the inventory report. It's not quite as exciting as trying to catch that original breakout, but it's still a pretty good way to trade. All right, Bo, I'm going to get to your question here in just a moment, so just hang on, please. Just see if we can't get a fill here. All right, they've settled in a little bit. So Bo is asking, I'm asking of the ideal target in ticks per crude oil and NASDAQ intraday trades, since we're not crazy about risk-reward ratios. All right, so for the Hawk scalper, a high probability target is $50 per contract. The Falcon swing trader, a high probability target is $100 per contract. And for the Eagle trend trader, a high probability target is $200 per contract. So if you're trading the NASDAQ at $5 a tick, you would need 40 ticks on the Eagle to make your $200 target. 20 ticks on the Falcon and 10 ticks on the Hawk. Oh, we got crude oil in a corner now. Now, crude oil, you can use the same high probability targets. However, you can see that crude oil can make some pretty enormous ranges. Therefore, with crude oil, I tend to double the profit objective. Okay, so we just got filled. You'll notice the trade manager gave us our stop according to the stop strategy that I've selected. I've got the break-even trigger in play. I haven't shown you how the break-even works yet. So watch it as it hits the break-even. You'll notice the trade manager will automatically force the trade to break even. There we go. Well, we're gaining. Yeah, not bad. Hit our high probability target here already in crude, but as I said, crude oil, I tend to double the objectives. Same thing for the Russell or gold or any of the markets that seem to make bigger ranges. Feel free to double your profit objectives. Oh, come on, get up there. Little lackluster follow through on that second breakout, but there's another way that you can trade crude. Moses is asking, so how many ticks on each of your bars? I forgot to mention this. This is the chart style that is native to the DTF system are the indicator warehouse mean Renko bars. Now you can actually purchase these separately if you like. They are the default system for the DTS system. Coincidentally, you can use like regular time charts if you prefer for your DTS system. You see, you still generate signals. You still get your first micro-macro cross. But some of the bars may turn out to be a little bit bigger. That's the E-mini, by the way. So to answer your question, Moses, with the come on, get up there. With the DTS system, we've got a 6-tick brick on the Hawk Scalper, an 8-tick brick on the Falcon Swing Trader, and we just got tagged on that little reversal, and a 12-tick brick on the Eagle. Those are our default settings. And again, those values were determined during the development stage. Now, those settings will work for 99% of the markets you're interested in. There is the odd market that we need to refine the brick size a little bit. The most noteworthy being the E-mini S&P, where we go with a 4-tick Hawk, a 4-tick Eagle, 4-tick Hawk, 4-tick Falcon, and a 6-tick Eagle. Moses is asking, can we take a look at the Dow on the Falcon? Absolutely. Just a moment while I load that up. And Rich is asking, how well do these strategies indicators work on the Forex? You know what, Rich? They work on any market you can plot on a chart. We've got several Forex traders. We've also got stock traders. Bear with me a moment here. Let's take a look. Okay, you asked about Forex. I don't know if I can get the pound US pair on this data feed. No. Oh, why did it not load? Okay, well, at any rate, we'll just take a quick look here. So here's the pound US pair. You can see here's a first micro-macro cross signal. Here was a first micro-macro cross signal. Here's another first micro-macro cross. Here's a macro pullback signal. So you can see the signals are still printing. I can't show you the Falcon, but let's take a look at the Eagle. Oh, very choppy session in the Eagle. No real trend here last night. Let's see about yesterday. Yeah, we got a couple hard edge bounces. Got a hard edge bounce here. Got a red bar buy signal off the hard edge. That's actually a high probability signal for the Eagle. Good follow through on that. But not much in the way of trend for the pound US pair. Let's take a look here at the euro. I'll get the euro dollar. This is the futures version, the 6E. And then Moses will take a look at the Dow. All right, so here's the euro dollar. Here's the euro dollar on the hawk. A little bit of a sideways session. You see, here's a good example. Here's a first micro-macro cross signal that prints. And if you placed your stop right there, boom. Oh, no, maybe you hit your profit target before it stopped you out. But notice, you just would have been tagged by 3 or 4 ticks before the market goes down and snags you. So if you left a more reasonable stop, maybe 2 swings back, up here, or even above the crest. Sometimes if you're at a loss, if you have a moving average on your chart, take a look at where your moving average crests and place your stop there. That would still be enough to keep you out of harm's way and enable you to hit a profit target. So just quickly here on the euro dollar, we have the first micro macro cross, we have a green bar sell, we have a 4 arrow consolidation. They're all just kind of jammed up in the same place. What else do we have here? Oh, a little macro pullback again. It gave you a little bit of heat. So here's that macro pullback signal, this guy right here. Everything stays in sync except the thin line. It goes out of sync. So you got a macro pullback signal. You took some heat on it before it finally went up to its profit target. Here's a first micro macro cross. This now around the London Open, which is why you see better follow through. London Open, first micro macro cross, macro pullback signal, 4 arrow consolidation, all kind of smooshed together again. All right, so there's the hawk. Here's the falcon now on the 6E. Nice trend change signal here just before the North American Open. Let's go to the European Open. Oh, another nice trend change signal just prior to the London Open. Look at that. It just, or at the London Open. Nice little trend line touch signal. So some pretty decent follow through. Another nice trend change signal right down there. Yesterday's session. That's in the euro. And let's take a look at the Eagle trend trader now. Good signal out of the London Open here on the Eagle for a trend. Got a red bar buy that's trying to flip the ATR over unsuccessfully. We've breached the hard edge, so we may see the euro start to unwind and maybe head a little bit lower here. Not much of a trend yesterday or the day before. And the day before that we had a decent downtrend. And the day before that had a phenomenal sell-off. Nice trend change signal here, and boom, down she goes. All right, so let's load up the Dow. Yeah, Craig's asking about choppy markets. I'll get to choppy markets in just a moment. Okay, Moses asked to see how this looks on the Dow. So this is the mini Dow, the YM. And actually I can kill two birds with one stone here. Here's Craig is asking about choppy markets. Can you talk a bit about these, how these keep you out of choppy markets? Okay, the Hawk Scalper, which, you know, the scalping tool intuitively is your fastest tool. It's going to alert you to a choppy market sooner than some of the other tools. Choppy markets tend to develop once we start printing these yellow bar clusters, especially when they start printing at more or less the same price value. So once we see, this actually happened the other day when we were trading, we got yellow bars, yellow bars, yellow bars. Now yellow bars need to occur when the trend changes. That's a given. But when you see yellow bars and no follow through, yellow bars and no follow through, yellow bars and no follow through, now all of a sudden you're thinking, okay, we're in a chop zone. The best thing to do when you're in a choppy market is just to identify that the market's in chop and leave it alone until it gets outside of that choppy zone. If you think this range is big enough, you can always try to sell the highs and buy the lows, right? Because the buyers, they're all down here around the bottom third, bottom quarter. The sellers are all up here, and the middle is no man's land. That's why we get all these yellow bars. The best way to trade a choppy market, though, is to let the market emerge from the chop, let it retest, and then let it show you that it can stay outside of that choppiness. Look for that signal, and vice versa to the downside. Get the breakout, get the retest, and then look for the opportunity to sell. So let's see how this played out then. So the market continues within the chop. Okay, we finally get a breakout from that zone. No, I haven't got the retest, but we did get the first micro macro cross. See right there. Again, it's the probability of the signals, right? Count on that probability of finding a high probability trade, and you can have some very good results. All right, so there's the hawk on the mini Dow. Let's take a look now at the Falcon. Nice trend change signal here on the Falcon. So the trend line changes color, goes from red to green. Essentially, it's the first signal that comes into sync, and that would be this one right here. Although you did get a second chance at it right here, and a late filter entry signal. The late filter entry signal occurs when the filter goes out of sync, comes back into sync, but the trend line never changes color. So some good news hit the market here. Incredible rally. Let's take a look now at the Eagle for the mini Dow. So pre-market we had the sell signal. This is a sell signal, but it's not one of our high probability signals. With the Eagle, I haven't spent a lot of time with the Eagle today. With the Eagle, you get your highest probability signals off of the hard edge bounces. So when the market hits the hard edge, we expect a reaction. So the market encounters the hard edge, comes out, produces a sell signal, you get some follow through. Market hits the hard edge, you get some follow through. The market hits the hard edge, we're actually producing green bars with a sell signal. This is a high probability signal, the green bar sell. Unlike the green bar sell on the hawk, which is not such a high probability signal, on the eagle, to get a green bar off of the hard edge with a sell signal is a high probability short. And you can see we had some nice follow through. A lot of sideways stuff going on there. See again, the hard edge, reaction. The hard edge, here's a red bar buy. You get a reaction. So the Dow now has crossed over, so we would be looking for a little bit of a retrace here and an opportunity to get in long off the next signal, preferably off of the hard edge. All right. All right, well, I took a little bit longer today explaining stuff, but you guys had such great questions, and I do appreciate the questions, I really do. Because well, today the market was relatively active, but when the market is dragging its feet, oh my goodness, it can be painful. All right, well, now we're kind of on hold after that rather quick rally. Quick rally up, now we're on hold. We'll just hang with the Dow here for a little bit, see if we get something going on. Oh, right you are. Tony says we got a 4-arrow consolidation building in the NQ. So 1, 2, 3, this is signal number 4. You know what I would do just for, it's an extra tick to enter above the high. I'd probably do that. Now, believe it or not, this is the best stop down here. But we'll play it a little bit tighter. Maybe I'll go with the 4-period ATR, and we'll do that. So we'll enter above the high, I'll cover it to the ATR. Oh, see, here's another thing you can do. Let's say you get a setup like this, and you don't feel comfortable running your stop way down there. You want to get by with something a little bit tighter. Go ahead and reduce the risk amount. So instead of 2%, maybe I'll risk 1%. And this way, if the trade works, great. If it doesn't work out, well, I've only risked 1% of my capital. Personally, I think we might be in for a little bit of a pullback here, given that quick run up, a little bit of a bullish break. Tony's asking about a crude oil hawk. Let's take a look here. All right. Yeah, we're working a 3-arrow consolidation and a macro pullback on crude. Crude making this huge run up from the inventory report. Next time I do the inventory report, here, let's get this trade on here. So 1, 2, look at that. Trade Manager will also prevent you from taking a trade you can't afford. All right, let's do it like that. I want something a little less aggressive. So you see we're already over the 30-day average as far as our daily range goes. So that might be all that crude's going to offer today. Everybody's gotten really quiet here all of a sudden. Tony's asking, where do you set the number of days for the day ranger? Okay, it's not on there. Oh yes, I remember. You go here to your data series. Go to your data series, and you need to have at least 31 days loaded. And I was struggling to get the NASDAQ over here because we just filled our 4-arrow consolidation, and I wanted to delete the profit target. But that's all right. We still got our scalp. Can't complain. But again, you rely on the probability of the signal itself. You go with your high probability signals, whether it's on your hawk or on your, sorry, where'd you go? Or your falcon. You know, if you focus on your high probability signals, you're going to increase your chances of a profitable trade. Okay, I think I heard we got a fill here on the crude oil trade. So ideally the stop should be back here. Let's see if we get a breakout. Sorry. Yeah, I hit the mute button. All right, you guys, I think we're going to button up the trading room here this morning. If you're trading this afternoon, the NQ, definitely bullish. Crude oil, well, it's made this big run up, but we've got a rather large gap, if you will, below here. So it would not be unlike crude oil to try to get in here, look for some support down here somewhere. All right, you guys and girls, we'll talk to you again tomorrow. DPS owners, I'll see you in the trading room, and we will have another open house session next Wednesday. We'll talk to you then. Bye for now.